What is up, traders? I've teased this long enough and it's finally here, the free day trading course here on YouTube, and it's going to be video number 1. Think of this as a crash course to my futures trading strategy that I use on a day-to-day basis. And in today's video, we're going to be talking more so about the beginner's guide to the futures market, and more importantly, the secret ingredient that separates pros from account blowers: market edge. So let's dive right into this. Let's give you more of a breakdown right after this intro. So here's what we're going to be covering today: the reality of futures trading and how to actually build an edge. We're going to also be talking about the steps to success even before you start learning the theory. What is it that you need to know? And finally, we're going to be breaking down the tools and the charts that you need to get started. We also have the chart book down in the bio. So this won't be some boring lecture or slide deck that we're going to see throughout all these 6, 7, however many videos there are. We're going to be going into examples. We're going to be breaking down real market movement. We're going to be looking at things live as they happen into actionable steps that you can use immediately. This also is a prelude. It kicks off the launch of our revamped full futures day trading course at TRADEPRO Academy. That's going to be starting to be filmed live October 2025. Now, the core concepts in the futures course, this new futures course, aren't different. We're just going to be making it way more actionable, very simple to follow through, and a little shorter. So it's not going to be one of those $2,000, $3,000, $4,000, $1,000 courses. It's about $300. You get lifetime access with every futures update included, and you can get that right now. If you join and sign up, you'll have a front row seat to the live recording that starts in October 2025. But on YouTube, enjoy this free breakdown, free crash course right here for about 6 to 7 videos, which should give you a very good understanding of the system that I trade. So now let's talk why 90% of traders lose money, right? They see Lambos, they see these massive payouts, they see prop firm flexes, but what they don't see is the discipline, the grind, and the repeatable process that actually makes money. Who knows how many years those people have been trading, or who knows if it's just smoke and mirrors. Trading is supposed to be boring, right? It's supposed to be a job, realistically, one you can repeat every single day without blowing up. And the only way to get there is by developing your edge, something that works in any market so that you can execute without emotion. The whole concept of one good trade, right? This is coined by Michael Bellafiore, all props to him, but one good trade, that's what you're focused on. You're focused on the process. You're looking at trade by trade by trade rather than looking at losses, P&Ls. You take one good trade, regardless of the outcome, you're looking for another good trade. That's what we're trying to get to. That's the edge that we're trying to develop. So let's dive into this journey and break down step by step the development of an edge, what separates the pros from amateurs. Now, we've talked about the main differentiator between the noobs and pros, edge, but what is it? What are the things that successful traders have that losers don't? An edge is a repeatable set of conditions, tools, and decision processes that over a large sample size create a positive expectancy. So it's not necessarily having a large win rate, it's not necessarily having a strategy that's better than others. There's several strategies out there that can make money, but what you're trying to do is consistently being able to pull money out of the market instead of gambling away. So the core difference: pros know their edge because they've proven it with data. Amateurs think that they've done it, but they haven't necessarily tested it. You can look at an edge from a mathematical point, right? It's measurable. The idea is to have an expectancy over 0. So what you're looking at is the win rate percentage multiplied by the average win minus the loss percentage multiplied by the average loss. So you're looking at your R&R, right? What are the deciding? There's 2 deciding factors in this formula, right? And you could increase, I guess, both of them, but one or the other a little easier realistically. So when you look at win rate percentage, the first part of the formula, win rate percentage and the average win, if you increase that, now naturally you're going to have some kind of positive expectancy. So what's easier to increase, your win rate percentage or your average win? Realistically, it's probably a little easier to increase your R to R, so your average win, rather than the win rate percentage. That's why the win rate percentage isn't necessarily the number one thing that we're gunning for that's going to make us good traders, right? Having the expectation of looking at the market with a 70, 80% win rate is just, it's a delusion of grandeur that you see propagated all over social media. It's not necessarily something that exists. because some of the best traders that I know have a win rate percentage between 30 and 50%. That's what's considered normal realistically. That's where your expectations should be set. So how can we break down this edge? Let's go through a list of these rules and break them down step by step. So number one, you have to understand what the hell you're looking at in the market before anything, right? You have to have a certain breakdown of market structure, of movement, of directionality. So that's where everything realistically begins, because we have to have a set of rules that's consistent before we can have any kind of edge development realistically. So you want to understand that. You want to be able to build out a narrative and build out a bias. You want to understand who the major market participants are and who's moving the markets, right? Institutional, traders, retail, algo, how do they all fit into this puzzle? Typically, you want to look at patterns, right? How are these patterns shaping up and what really sets them apart? So maybe time of day, economic events. You want to also understand how liquidity and volume influence price movement. So a tool set and market structure philosophy that really gives you a bias breakdown and a narrative, what we're going to be using is going to be auction market theory. So this chart right here, this volume profile chart, is going to be our bread and butter to begin things, right? This is going to develop our understanding of directionality, areas to trade, right? How market participants are actually creating a narrative so we can develop some kind of bias, long, short, areas, right? A+ trades, and all of our setups are going to come from this. Now, I'm not saying this is the be-all and end-all. Obviously, we're going to be talking about market structure from a very basic and generic understanding of trend movement, right, in the next video, but this is going to be a very, very important chart for us. We're going to be focusing on auction market theory, price action, and order flow. The second part of our journey to developing an edge is identifying repeatable patterns, right? They could be technical, realistically, some kind of structural or behavioral type of patterns. Now, what we're going to be focused on is going to be more of a structural / technical understanding of pattern formations, right? Which generally does come from market participant reaction. So a lot of these repeatable patterns are going to be divided into pretty much two categories for our setups. Pullbacks to continue with a trend and failures to continue with a trend, so fades. Those are going to be the repeatable patterns that we're looking for that really quantify our A+ trades that are predominantly based on this chart. So when you're trying to develop your edge, you want to write them down, and if they work, right, continue to test. If you see very inconsistent results with them, right, maybe you want to abandon them and look for something else. So what we're going to be doing is showing you those consistent actual setups. One of these very generic repeatable patterns is based on balance, right? Balance is going to be an area that the market creates in terms of a belly of the volume profile. So we're looking at extremes of volume profiles that surround bellies. So one of those repeatable patterns is if we move outside of that belly and fail, right, we're going to be looking for a reversion back into the bottom band. If we move outside of this belly to the downside and fail, what we're going to be looking is for a move back into that area, right, which happens often on session trades, right? Even yesterday, we get a move outside, we fail, we roll over. We get a move outside, we fail, we roll over. So what we're trying to do is identify something that's consistently repeatable. And it's not like, oh, okay, we're moving out, that means there's going to be a failure and we have to just start selling. There's going to be cues that actually generate that idea to give you a higher probability that it's actually going to work. So number 3 in the edge development, we want to test these theories. We want to generate some kind of sample size. Historical chart review to see some kind of patterns like these work 50, 100, 150 times. The larger the sample size, the better understanding of a measurable expectancy that you'll have. You can use sim, right? You can use replay features on Sierra charts. You can paper trade it, micro trade it, prop trade it before getting into a live environment. I would honestly look at sim and prop trading to kind of test these things out and then start moving into a live environment with your own capital, or even just sim for a bit. Get that sample size down and understand what your best systems and strategies look like, your best setups that actually have some kind of positive expectancy. You want to build rules around risk management. This is going to be a huge component of what we're going to be talking about. So it's either a fixed percentage or a fixed dollar per trade, and you want to have a max daily loss limit to prevent tilt and define when not to trade, right? If you're not trading in an area, for instance, because one of the huge downfalls of traders is that they just want to trade, right? Market's moving, okay, I got to get into a trade, but what that does, it just completely takes away from the whole concept of the first 3 steps of developing an edge, right? If I'm not waiting for the rules that I want to establish to create this edge in terms of a system or setups, then none of it even matters, right? I want to have that defined list of rules, which means that I want to trade from certain areas. If the market's not trading at those areas, then realistically you shouldn't be putting any risk on the table and watching and seeing how things shape up. Another thing is setting up a max loss, right, on a day-to-day basis. That's going to be very, very important to keep in the markets, right? Have longevity. This should instill discipline and prevent tilt. So when we have, again, this sample size, like I said, we do want to measure the expectancy. The next thing is we want to refine and specialize. So you want to drop setups that don't perform well. If you have a list of 3 setups, right, 4 setups, maybe it might even be too much. Some traders only use 1, some traders use 2. We're going to be looking at 3 general setups in the market throughout this course. And, right, you want to double down on your highest probability conditions. So which setup do you notice in your sample size that completely outperforms? It's the one that really sticks out to you, and maybe you just want to sit there and abuse that. And the thing is, right, when you're intraday trading, and I'm not talking about scalping, you're probably going to find 1 to 2 really high opportunity, good opportunities on a day-to-day basis that really represent your A+ setup. Everything else, you know, you could go without it. And that's exactly what I'm going to try to define. The last part of it, right, scale gradually. Once your edge is proven, you have a sample size, you want to prove it on a small scale first, right? You're going from a simulated environment into a live environment. And then you want to start with a small amount of size. Once that's proven with small amount of size, realistically, it's one of the easiest businesses to scale. If you have a proven edge when you're trading maybe 1 to 3 to 7 to 8 micros, well, there's no real difference other than maybe the emotional factor that your risk is increased, but there shouldn't really be an issue for you to get from maybe 3 micros up to 7 micros, up to 1 mini, up to 2 minis, up to 10 minis in a gradual course of time if you have a positive expectancy, right? Do it gradually. You don't want to do it from like, oh, okay, I've proven myself with 3 to 4 micros, now I can trade 3 to 4 minis. That's going to be a huge shock to your risk acceptance and your emotional state of things. And even if you have a great strategy, your mental might crumble, your psychology might crumble, and everything goes to crap very easily. Right? So you want to scale based on your account scaling. You want to keep the same percent of risk consistent. It works with 150 trades, right? You have 50% win rate, and then all of a sudden it drops down drastically because you oversize. So let's break down some examples of real futures trading edges to give you an understanding of what some things are, right? What are some of the things that you might be focused on? Because we said, okay, an edge isn't necessarily a strategy or a system, right? An edge isn't going to be some kind of strategy or a system itself, right? Because there's a bunch of people that are trading based on volume profiles. They're looking at the same stuff I'm looking at. There's a bunch of people that trade on price action, right? VWAPs, all this stuff. So what is a real differentiator? A type of edge, as an example, could be the time of day volatility exploitation, right? For instance. So for instance, maybe some traders trade the first 45 minutes, the first 30 minutes of the market open when there's a little more volatility, and they trade the last half an hour, right? And they try to really abuse that. Or you could be one of those traders like me that avoids the first half an hour altogether, even the first hour sometimes, to get that initial bounce, to get a better understanding of where the market's trending. So even if I avoid this whole portion of the market, what I can see is that there is some kind of patterning shaping up, right? Maybe I don't see too much of direction and trend movement that's taking place throughout that morning session, that first 30 minutes, that first hour. But once I see things actually setting up after that, then I can get a better understanding of what's going on. For instance, right, I can see in the first 5 minutes that we accept back into a distribution. So there is some bullish momentum from that area. Right? I can maybe look at that. I can maybe try and get on board that because this is going to be in the first 30 minutes. Right after that first 30 minutes, maybe I can get a piece. If I wait a little longer for the initial balance to shape up, I can see that there's a failure outside of this distribution on the bullish momentum. So I can try to take advantage, honestly, of pulling back into the balance, and then the failure here pulling back into the balance, and it makes it a lot easier for me to understand what is actually shaping up. So what you've noticed maybe throughout this example is I'm looking at only 2 levels, the balance extremes, which happen to be these 2 areas, the top and the bottom of this balance. So that's where my edge comes from, the patience of waiting for the information to come in based on the system and the setup of rules. I only have 2 areas to trade throughout the whole day. If XYZ doesn't show up, then I'm not trading. I don't have to take any trades. I took 2 trades yesterday, that was it. Another type of edge that we can see is maybe your ability to read order flow, your ability to read the footprint. Now, I can see this more as a controversial one because it has more to do with your understanding of the actual chart information. So maybe honestly, some people are better at reading order flow than others. Obviously, like there can be massive differences, but anyways, another one is a statistical tendency. For instance, right, if you're looking at pure statistics, which is more so on the automated front of things, so if you can see maybe the initial balance trade, this is going to be one of the statistic examples that I have. So the initial balance trade after 11 a.m., right, once the first period of the after the initial balance actually forms, because the initial balance is to 10:30 a.m. Eastern time, that's the initial balance close. So the first period is going to actually close at 11. After 11, I can get an understanding of what's going on with the initial balance. If we move outside of the initial balance area, right, which is these 2 blue lines, let's say in this instance the top, and we move out, but the period actually closes back inside that initial balance, there's approximately a 70% chance that we are attempting to go and revisit the other side of that initial balance, right? If we close outside of the initial balance on a period after 11 a.m. realistically, then we expect to have a trend move that's approximately 70%. So some people maybe just abuse statistical advantages and tendencies like that, but that requires constant reshuffling and understanding of how these statistical tendencies generally change. Right? Some people trade based on news and event reaction a lot. They abuse, for example, crude oil inventories, non-farm payrolls, Fed events. Those are things that I really stay away from, but again, some people, that's their advantages. Some people look at what we call quote-unquote head fakes or liquidity grabs, whatever it is. Other people look at correlations and spreads, right? They trade S&P and NASDAQ based on divergences with Dow Jones, whatever the case is. My point being is that there's a lot of different things that you're looking for in the market which create inefficiencies so that you can abuse, and that's going to be your edge development. Where are the inefficiencies that make the most sense to you as a trader and that you could realistically abuse in the market to have some kind of positive expectancy? That's what we're after. That's the goal. And I'm going to be breaking down the setups that create the opportunity for an edge like that. Now, obviously, everyone's going to be different. My edge is going to be different from your edge. Your edge is going to be different from the next person's edge, most likely, realistically. That's going to be the case. And you're going to have to really break down the theory and make sure that you make any system that you take a little bit of your own, because that's the only way that it's going to actually work for you, right? Cookie cutter approach, this, that, blah, blah, copying all of it. It's probably not going to work. It can work for some people. There's always going to be something that you understand differently from another person realistically. So you want to take that into consideration when you're learning strategies, when you're learning this setup. Now, take this into consideration. There could be 2 traders, right? They could have the same setups, the same system, but the differentiator is execution discipline, right? That could be a more so behavioral / psychological edge that people can incorporate. So one of them sticks to the stop loss 100% of the time, right? Take the loss, process over P&L, and just continue. Next trade, one good trade, one good trade. One could also avoid over trading in choppy sessions. So if they don't see their setup, there's nothing really in it. They want to pass up on low quality setups as well. So again, right, if I'm trading in this range type session from yesterday, realistically there's only 2 types of scenarios for me to trade into. I want to be careful trying to sell or buy right into support and resistance. One of the things that I like to find is these head fake reversal moves. So if I don't see something like that, right, I might pass up on the opportunity. Another trader might say, you know what? I'm going to shoot it here, 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 here. Every time we test resistance and support, they'll shoot it, right? So they might be getting into any position based on support resistance. I might be waiting for specific criteria. One trader might scale in and out on predefined levels, and the other one might do it based on emotion. So that can really, these types of behavioral and psychological edges also play a huge factor in being able to actually create consistency in your strategy and generate profits out of the market. There's a possibility that your edge can actually decay as well. It might have some kind of half-life realistically. You want to be able to maintain your edge. You can constantly adapt through continuous data review, right? Forward testing, slight little micro adjustments, reducing size during drawdowns, and you want to build multiple micro edges instead of one general holy grail strategy. Now, I've talked a lot about edge, so I'm going to give you a short and sweet breakdown of how to actually succeed as a futures trader as you go through these videos through this course. There are just 2 steps, right? Generate heavy discipline so that you can follow your trading rules, and journal so that you can learn from what you do poorly and what you do well in the market. The number 1 teacher in the market is going to be the actual market and how you execute. So your journal is going to save you more than you'd think. I know it's a tedious task, and I've asked multiple traders to just show me a journal, do your journal, and that's going to be a huge differentiator, believe it or not. So those 2 things, discipline and journaling, are really going to help you progress through this course as you watch it here on YouTube. Learning the theory isn't necessarily rocket science. You can take it step by step and generate a trade plan, understand the steps, which is what we're going to be doing in the coming videos. However, trading is still inherently hard, so you'll need to be very stringent in your approach to better yourself through discipline and, first and foremost, journaling, right? Understand what it is that you do. So, the final part of this video might have been a lengthier video. I want to leave you guys off with this before we start looking at anything that's based on the actual structure, setups, charts, whatever theory. What kind of charts and software do we need? So when we start trading futures, right, there's a bunch of different platforms available out for everyone. I'm predominantly going to be trading on Sierra charts, right? Sierra charts is going to be my number 1, and I can provide you a template with a link in the bio to download just that chart book, just this chart book that you see right here in front of you. What we have are volume profile charts. We have just some tick charts to see some price action, and we have a footprint, right, along with some other hidden charts that you'll find in the chart book. What do we need? Any software for futures trading that has some kind of volume profile that's very highly customizable, as well as a delta profile, those are going to be the core concepts of our auction theory and order flow. So it's not necessary that you have a heat map, but it is pretty effective for some of the things that we're going to be talking about in terms of the setup. I would honestly, for this system and how I trade, I don't necessarily recommend TradingView, right? You can look at things like Motive Wave, Ninja Trader, Sierra charts, right? They all have a lot of different customizable options. And going through these charts very quickly here, I have a volume profile chart for NASDAQ and the S&P. This is going to be the cornerstone of the majority of the use for this system, right? We're going to be looking at this probably 70% of the time. And this is where we develop the trade setups and understand market directionality, narrative, and bias. What we have over here is a large composite profile. Generally, I recommend anywhere between 200 and 400 days of cumulative volume. Over here is the last 5 days profile, and each one of these is an individual session profile. The ETH is the lighter background, the RTH is the darker background, and these are volume profile heat maps that are attached to their own market profile. This market profile isn't fully necessary, but this is what we have on this main chart. Over here on the tick chart, right, we have the same one, well, the volume profile chart, we have the same one for the ES. The tick chart over here, this is the NASDAQ, below is the S&P, and I draw these levels manually for anyone that's wondering. These are my key balance extremes that I try to trade from. What we have here is just a 12-point chart on NASDAQ, a 3-point chart on the S&P, range charts, and we have delta and a volume profile, session by session delta profiles and volume profiles, along with the initial balance over here. One of the final pieces, I guess, is the footprint. We have a footprint chart here for both NASDAQ and the S&P. What we have here attached is the prior session volume profile with a delta, and we have the overnight volume profile with a delta. Individual footprint delta candles, 12 points on NASDAQ, 3 points on the S&P, so the delta is on the right-hand side attached to these candles. And we have these extenders which highlight very heavy delta imbalances on the price. We also have a view app, but then this matrix down below for both NASDAQ and the S&P. And then one of the last things here that may not be seen on the screen is a actual just delta profile on NASDAQ and the S&P along with DOMs. So with that being said, like I said, you can get this in the link down below. You can join community.tradeproacademy.com to find it in the pinned posts on Discord. And the last thing that I want to say is that if you want to watch the full course 100% in detail with all the examples, the refilming starts 2025 October, and we're going to be doing that in front of everyone at Trade Pro Academy that owns the course, so you can go and get that right now. We'll drop the link in the bio. Otherwise, get ready for the next few videos, as we're going to be talking about more hands-on approach, and next time we're going to be talking about market structure, what really moves markets, and auction theory, a crash course breakdown. So I'll see you guys in the next video. I hope you thoroughly enjoyed this and got a good understanding of what it is that we want to start off with. And don't forget to hit that like button, that subscribe button, and I'll see you guys next time.